The day the system failed for years, silver traders knew the pattern. Every rally ended the same way. Silver would rise, momentum would build, excitement would return, and then, almost always on a Friday afternoon, the price would suddenly collapse. No news, no economic data, no explanation. Just a wall of selling so large it crushed the market in minutes. It became known as the Friday kill switch. And it worked until it didn't. On December 13th, something unprecedented happened. Silver didn't just break higher, it exploded to $67 an ounce and held. No crash, no kill switch, no suppression. And in that moment, a system that had been quietly manipulating silver for decades began to unravel. Because behind the paper price, the physical silver is gone. Part 1. The long history of silver suppression. Silver is not a normal commodity. It is both. A monetary metal, a critical industrial input that makes it uniquely dangerous to control. For decades, major global banks have dominated the silver market using paper contracts, futures, swaps, and derivatives that represent silver but are not silver. These contracts allow banks to sell silver they do not own, create artificial supply, suppress price rallies. At times, the paper silver market has represented $100, 250 times more silver than physically exists. This is not speculation. It is documented in regulatory filings, and for years, it worked. Part 2. The Friday kill switch. Explained, the kill switch was simple, but devastatingly effective. Whenever silver started to rise, banks would dump massive short positions. Tens of thousands of contracts would hit the market at once. Liquidity would vanish, prices would collapse. A typical move, silver climbs from $27 to $29. Then, within minutes, a paper avalanche smashes it back to $27. This trained traders to expect failure. Rallies were sold. Momentum died. Confidence vanished. Silver became the most manipulated major commodity on Earth. Until December 13th. Part 3. December 13th. When the switch failed. On December 13th, the usual playbook was deployed. Paper silver was dumped. But this time, it didn't work. Buyers absorbed the selling. Price surged through resistance. Stops were triggered. Shorts were forced to cover. Silver ripped past levels no one thought possible. $40, $50, $60, and then $67 an ounce. The kill switch failed because the banks ran into a problem they could no longer paper over. There was no physical silver left. Part 4. The Comex inventory collapse. To understand why this matters, you need to understand the Comex. The Comex is where futures contracts are settled. It is supposed to represent a credible link between paper contracts and physical delivery. But here's the problem. Only registered silver can be delivered, and that inventory has collapsed. In just 2 years, registered silver is down 86% from hundreds of millions of ounces to just 47 million ounces. That is all the silver officially available for delivery in the world's largest futures exchange. Now here's the fatal flaw. Part 5. The math that breaks the system. Over the next 2 months, Comex delivery obligations total over 500 million ounces. Let that sink in. 500 million ounces promised. 47 million ounces available. That's not tight. That's not stressed. That's mathematically impossible. Even if every ounce were delivered, which it won't be, the system still comes up short by a factor of 10. This is the definition of a short squeeze. Part 6. ETFs are exposed. For years, investors were told, just buy silver ETFs, it's the same thing. It's not. Most major silver ETFs, including SLV, do not guarantee physical delivery. They rely on banks' unallocated silver promissory claims. In other words, IOUs. As physical silver vanished, ETFs faced a problem. They couldn't source real metal, so instead of buying bars, they accepted paper promises from the same banks that are short silver. This is circular risk. Part 7. The PSLV signal. There is one major exception. PSLV, a physically backed trust that demands real metal. No paper substitutions, no IOUs, no derivatives. And what happened? PSLV began trading at a 12% premium to spot price. Why? Because investors are willing to pay extra for something that actually exists. That premium is a market signal. Physical silver is worth more than paper silver. Part 8. Smart money makes its move. Now let's talk about the people who see crises before they happen. Michael Burry, the investor who predicted the 2008 housing collapse, he made a very specific move. He sold all paper silver exposure, sold mining stocks, dumped ETFs like SLV, and moved into PSLV cash. This is critical. He is not betting on silver going up. He is betting on paper silver failing. That distinction matters. Part 9. Why this isn't just a price story. This is not about $67 silver. It's about counterparty risk. If the Comex cannot deliver, if ETFs cannot source metal, if banks cannot close shorts, then paper claims become negotiable. Delayed, cash settled, frozen. That is exactly how financial crises unfold, not with announcements, but with temporary measures. Part 10, the CFTC emergency signal. In mid-December, something extraordinary happened. The CFTC issued an emergency order. It temporarily exempted banks from position limits on silver derivatives. Translation, banks were allowed to hold unlimited short positions. This is not normal. This has happened only twice before. During the 2008 Lehman collapse, during the 2021 Archegos Credit Suisse crisis. Emergency exemptions mean one thing. Regulators see systemic risk. They are buying time. Part 11. The January 20th deadline. The most important date in this entire story is January 20th, 2026. That is the day the CFTC's emergency exemption expires. Up until now, regulators have effectively suspended the rules, allowing major banks to exceed normal position limits on silver derivatives. This was not done casually. It was done because enforcing the rules immediately could have caused a disorderly collapse. But emergency exemptions are not permanent. When January 20th arrives, banks face a brutal, unavoidable choice. They must either close their massive short positions or post enormous amounts of additional collateral to keep them open. And this is where the system hits a wall. To close those short positions, banks would need to buy roughly 8 times more silver than physically exists in Comex registered inventories. That is not price discovery. That is not a functioning market. That is a detonator. It is a moment where arithmetic overrides liquidity and where promises collide with reality. Part 12. What happens? When shorts panic. Expanded. There are only 2 realistic paths forward, and neither is orderly. Scenario 1. Shorts try to cover. If banks attempt to buy their way out, prices move vertically, not gradually. Liquidity disappears as sellers vanish. Bid-ask spreads blow out. Delivery demands overwhelm the system. In this scenario, silver doesn't rally. It gaps. And gaps are how markets signal failure. Scenario 2. Regulators step in. If regulators decide the market cannot handle forced covering, cash settlement replaces physical delivery, trading halts or position freezes are imposed, rule changes are introduced mid-crisis paper, silver holders are told they will be made whole in currency, not metal. But history shows that in these moments, contracts are reinterpreted, timelines are extended, access is restricted. Either way, the result is the same. The paper-silver market breaks, and history is very clear on what happens next. When paper markets fail, physical assets reprice violently because they are no longer anchored to artificial supply. Part 13, why this is not a conspiracy. Expanded. None of this requires secret meetings or hidden documents. Everything discussed here is publicly available. Comex warehouse reports, ETF prospectuses, CFTC emergency orders, investor filings, and disclosures. This is not theory. It is not speculation. It is not a narrative. It is math. You cannot promise over 500 million ounces of delivery when only 47 million ounces exist in registered inventory. At some point, accounting identities assert themselves. At some point, reality wins. Markets can delay that moment. They cannot escape it. Part 14, who is at risk? This is not about who makes money. It's about who gets paid in metal and who doesn't. The most vulnerable futures, holders expecting physical delivery. ETF investors assuming full metal backing institutions, relying on paper hedges for risk management. These participants are exposed to cash settlement risk, contract modification, delays, or forced rollovers. The most protected holders of physical silver in hand, fully allocated, audited trusts. Investors completely outside the paper system. This is not a trade. It is a counterparty question. When stress hits, the market doesn't reward optimism. It rewards ownership. Part 15. The moment the music stops. Every major financial crisis has a moment when confidence breaks. 2008 had Lehman Brothers. 2020 had the Treasury market seizure. 2023 had cascading bank failures. Silver's moment may be January 20th. The day exemptions expire. The day shorts are forced to confront reality. The day regulators must decide who absorbs the loss. Because once confidence breaks, markets do not negotiate. They reset, and resets are never gentle. Final warning. This is a structural event. Expanded. Silver at $67 is not the real story. The real story is that a decades-old suppression mechanism failed. The paper silver market grew far larger than the physical market that supports it. And now that gap is being exposed in real time. When the music stops, paper holders may be settled or delayed or frozen. Physical holders hold leverage, not because of price, but because of scarcity. This is not a rally. It is a structural reckoning. Prepare. Don't panic. This is not financial advice. It is a warning. The data is public. The signals are visible. The deadline is known. Markets do not break gradually. They break suddenly and without warning. And when they do, repositioning is no longer an option. The real question is not whether silver has been manipulated. The real question is what happens when the manipulation can no longer be maintained. Because December 13th may have been the day the kill switch failed, and January 20th may be the day the system is forced to answer for it.